All right, I'd like to welcome everyone to the Oklahoma City Post-Employment Benefits Trust meeting for Monday, May 11th. And the first item that we have is to welcome Ms. Berry to the meeting. Sorry. That's what she wanted. Yes, you're welcome. You're welcome. First item is to approve the minutes from the meeting from April 13th. All in favor? Any opposed? Next is to receive, actually the next two items, we have received the monthly investment flash report for April, and we have the presentation of the first quarter, and Doug, you can present those in whatever order fits. Thank you.
Thank you, Mr. Chairman. I think I'll start with April 30 this time because the results are favorable. If you take a look at the April 30 report, first number I like to call attention to is the total market value. We're very close to $36 million at the total fund level. As we look at this report, it is remarkably different from December 31st and very different from 2 years ago, as we have many new investments and the portfolio is much more diversified. As we go from the top down, you'll see the Loomis Sales bond portfolios, which is a more aggressive or assertive bond portfolio that invests in credit and mortgages. You can see it was up 1.6% while its index was actually down during the month, and it's outperforming over the last 3 months as well. You'll notice that there's a lot of gray shading on the investments here. That indicates periods before we were actually invested in them. And you'll notice when we're looking at this just how new many of the investments in the portfolio are. So as we go down to double line, that is another fixed income portfolio that we diversified into a little bit, or almost a year ago. Its returns have been more stable, I guess you would say, than the Loomis Sales, but that's how we intended this to be. And you'll see our high yield bond portfolio over the last 3 months performing very well, and over the last month, 1.3%. Now, we've got one fixed income investment that for this period of time does not look great, and that's the Hoisington active duration. And remember, this is the fund, this is the one that diversifies everything else in the portfolio. So we're seeing that it is negative on the month because interest rates rose slightly, and they remain invested in 30-year treasuries. So this is a risk abatement portfolio most of the time. But sometimes when interest rates tick a little bit higher, like they have over the last 3 months, you will see losses in this portfolio. Talk to Hoisington a lot. They will reduce the duration of the portfolio, or they will take its risk profile from where it is now to roughly T-bills if they think interest rates are likely to continue rising. So by this, you can see that they're remaining long, that those bond prices have gone down slightly. But with our conversations with them, and especially after seeing the first quarter GDP results, which were barely positive, they are thinking that there's no way that long-term interest rates can rise significantly from where they are today. Now, remember, we started the quarter, we ended the quarter with rates in the 2.5% for a 30-year Treasury bond. They've moved up into about 2.8%. But we've been through this cycle with Hoisington many times over the past few years. So the returns there look difficult. If we look from inception until March 31st of this year for Hoisington, how long we've been invested with them, they're up over 20%. And again, this is a very unique portfolio. So moving down to the equity, where we did significant amounts of work, and we had a lot of new investments on March 30th of this year. You'll see our index fund is performing exactly how it should. Remember that the inception date on that is March 30th, and we took half of the allocation that we had to the Dreyfus Appreciation Fund and moved it into this index vehicle so we can have cheap index performance. You'll see that since that 1 month period of time since we moved those assets over, Dreyfus Appreciation actually performed well. So that's a price of diversification. Sometimes we'll move away from an investment just prior to it outperforming, but long term we expect these two to play very well together. Remember that the Dreyfus Appreciation is a very low volatility portfolio, investing in very large, very diversified companies. You'll see in our next portfolio, the Vanguard Mid-Cap Index, and remember we diversified our mid-cap exposure in the same manner into an active and a passive piece, and this is our plan going forward. And I remember the last time that we met, we were very adamant about this. This is our new plan. We are going to stick with this plan and then decide in the future if we do need to make any changes. Obviously, 1 month, no reason to consider that. You'll see that the index fund tracked its benchmark perfectly, and that Hotchkiss and Wiley, this contrarian portfolio that underperformed for a little while before this, ranked in the 6th percentile of its peer universe. You'll see that also the same story is true for Stevens, our small cap growth equity portfolio, which was down less than the benchmark, and starting to repair some of the damage that the underperformance it had in previous year, because primarily they didn't own biotech. And biotech is a part of the index that grew enormously over the past year. But for Stevens, it's just not reliable enough that these tend to be companies that either win or go bankrupt, and they decide that doesn't work with their sort of more conservative process. Our international equity portfolio performing well during the month, and you'll see at the total fund level 1.6% rate of return. That's versus 0.4% for the actuarial assumption, better than the policy index and better than the allocation index. So 1 month result, much better than we would have expected, but we're very gratified to see that the existing and the new investments are all working. Happy to take any questions. Mm-hmm.
And one of the things that I noted that concerns me is that it was mentioned during one of the seminars that the index funds are now significantly increasing their fees for the information that is being provided to the managers, and that those managers are then going to be forwarding those fees to them. So can you talk about that a little bit?
Sure. So what you're saying is that the index designers, the people who build the indexes, are now they're increasing the licensing fees to the people who
So I'm concerned about the impact on our returns.
Sure.
And whether our returns currently or will in the future reflect net fees. So that we can show what the returns look like based on the market, in addition to everything minus those fees that are being passed through the fund.
Sure. So all the results you see here are net of fees. Now, what you're talking about, the index providers charging the index fund managers more money, that is a phenomenon that we've been seeing. And one of the reasons why is that with, ETFs are everywhere. And there are all of these different companies out there that are saying we're going to manage this index fund, that index fund, and they've never done it before. And so suddenly the index fund or the index designers now have a very large new clientele. And they're saying to this, well, our product is more in demand now, so we can raise our fees to these new entrants to the market. Now, the nice thing that you see on your lineup here is that Vanguard is your provider. Vanguard is the biggest index fund manager out there, and they are the cheapest index fund manager out there. If you look, you'll see the S&P 500 is the benchmark for the large cap, but if you look down to the mid cap, you have this CRSP US mid cap index is their benchmark there. So this is the Center for the Research into Securities Prices. That's what CRSP stands for. Now, prior to about 2 years ago, this was benchmarked to the Russell mid cap, but Russell tried to raise the prices on Vanguard, and Vanguard said, see you later. We're not going to pass those fees along. We can go somewhere else and find a cheaper alternative to your index licensing fees. So it is happening. Vanguard fights tooth and nail for every nickel that they pay everyone. The interesting thing about Vanguard is that it is owned by its shareholders. It's like a mutual insurance company. So they're very cognizant of fighting for that. And it should be interesting to see how that plays out. It's really not that difficult to build an index. So,
So if there were changes in our fees in any of the current investment funds we have right now, would we receive notification of that?
Yes.
How would that get changed?
Well, if you're talking about just the index funds.
Yes.
I mean, we went through this with several of our clients. They send you notifications, say, we're changing our fee structure and passing along more fees, or we are changing our index. So there would be notification to us, and we would provide it to you. But it's one of these great undercurrent stories that the advent of ETFs and all of these other index vehicles is causing to the industry. Mm-hmm. Mm-hmm. Sure. Mm-hmm.
And if that's the case, that's going to grow any returns that we see. Obviously, the manager is going to have to sign off.
Sure.
So I think it might be worth looking at that.
Mm-hmm.
Something that we should explore at some point in the future. But I just thought
Just for clarification, who is the firm again? NASDAQ?
along with, I believe there were 3 other individuals, conference representatives who were moving towards these alternate index.
Okay.
So for the purpose of this trust, the 2 Vanguard funds are the only ones we have that are index funds that would really kind of fall into that area?
That's
Is that
correct.
right? And you're saying that if we do see changes in the fees, we'll receive notification that we'll bring back to the board to
Correct.
discuss?
Correct. Now, the fees are very small for the index funds in terms of basis points. So if the index provider says we're going to charge another 2 basis points, I mean, it could increase your fee by 50%. So small margins can make a big difference.
Are there any other questions or comments on the April report? All right, while you're standing right there, I'll just go ahead and take a motion to receive that report. All in favor? Any opposed? Great. And so now Doug is going to cover the presentation on the first quarter report for 2015.
Thank you. So this is the larger report. It is the quarterly executive summary report. And remember, I'm talking about changes that were made at the very end of the quarter that we've already talked about, and we're happy with the initial results. So this is a little bit obsolete, if you will. I just want to cover a few things in detail that show up in the quarterly report that don't show up in the monthly. Market environment was interesting, where we had domestic equities underperforming international for the first time in a very long time. You had interest rates moving in different directions, both domestically and internationally. Oil prices stabilized, the U.S. dollar stabilized, and indeed we've seen some negative movement in the U.S. dollar versus other currencies just recently. U.S. economic growth on page 1, the lower right-hand side, you'll see that the first reported U.S. real GDP growth was just 0.2%. For the quarter, which was a negative surprise, and that included an extremely large inventory build. So first quarter economic results were very disappointing. Of course, some folks are blaming that on the weather. If you remember, it's hard to remember with how beautiful it is today, how difficult of a winter we had, but it was very difficult. But employment growth has been disappointing over recent weeks as well. Equity markets on page 2, you'll see on the lower right-hand side, performance for the S&P 500 sectors, just calling attention to the best performer was healthcare, up 6.5%, followed by consumer discretionary, and then telecommunications. Negative returns during the quarter, energy, of course, at negative 2.9%, buffeted by volatile oil prices. Utilities down 5.2% as well. Interesting column on this, and if you just like to take a moment, but the beta of the individual sectors versus the S&P 500 is shown in that table. And so this tells you how volatile these individual sectors are to the index itself. And you'll see that consumer discretionary is 1.13 beta, which means it's 13% more volatile than the index itself. But then you see consumer staples That's soap, detergent, et cetera, things that we have to buy, how stable that sector is at 0.58. So there's some amazing diversity in the volatility, going down to utilities at 0.47. In information technology, people think that would be probably the most volatile, but it's only 1.11% beta compared to 1.44 for financials, which is understandable given the last 5 years of the market performance. Fixed income on the following page, page 3, you'll see lower left-hand side what the quarterly returns of these various indexes are. Inflation-linked bonds, TIPS, were up 1.5%, investment-grade corporate up 2.3%. Again, those are really strong returns given where yields in the bond market are. Going across to Treasuries, 1.6%, the Barclays aggregate 1.6%, and then the 30-year Treasury at 5.1%. Global aggregate ex-US was the sole negative return. That's primarily due to the strength of the dollar when they're trying to translate the returns of foreign fixed income back to U.S. dollar terms. It's negative. In the foreign bond markets are extremely fascinating right now in a bit of a troubling way. There's probably $3 trillion of European sovereign bonds that are currently trading at negative yields, going out to a 10-year maturity where you actually are losing money to get the safe return of your capital, or at least most of it, because of the enormous quantitative easing that the European Central Bank launched earlier this year. So there are some odd things going on out in the world, and probably the fact that interest rates are so low overseas will keep ours lower than they would naturally rise to right now. Because if you look at a 2.5% yield or a 2.8% yield on a 30-year Treasury, compare that to a 30-year Bund or a 30-year Japanese bond, and it looks very attractive right now. We won't talk about alternative investments because we have very little here, but when you look at the total fund returns or the index returns on the following page, you'll see for the year, S&P was up 12.7%. The mid-cap index was up 13.7%. Russell 2000 was up 8.2%, and the index, the Barclays Capital, was up 5.7%. Going down to the EFA index was international equity, down 0.9%. So prior to very recent periods, domestic equities have beaten international equities by a very wide margin. But looking over the last quarter, S&P was up 1%, EFA was up 4.9%. So international diversification paying off during the first quarter. Following page is the big green number, 4.4%. So a relatively modest return from a conservative portfolio. As we go on the following pages, I'd like to call attention to, let's see, page 10. This is showing the allocation of where we had investments. You'll see that a lot of these numbers have very low contributions to the 1.9% rate of return. But you'll notice the double-line bond, which is one of the new ones, the Hoisington, relatively small allocation, but big contribution to returns. Stevens small cap growth, and then the Causeway International Value, positive contributions during the quarter. Discussion items on page 11. Again, portfolio has undergone a tremendous amount of change. There's a flurry of activity at the end of the quarter where we diversified our large cap exposure, where we selected a new mid-cap manager, a new mid-cap index fund, and those changes went into place at the very, very end of the quarter. If we look back to 1 year ago or less than a year ago, July of 2014, that's when we added two fixed income managers, three fixed income managers, and then we had that delayed investment into the Lord Abbott Fund, which was frustrating, but at the end of the day, when we look at it, it was better to wait to invest in high yields when we did, as high yield had a difficult second half of the year last year. So the delay was actually positive from a return standpoint, as frustrating as it was. You'll see on page 12 the growth of the portfolio, tremendous. Most of that is due to cash flows. Investment returns have contributed some. The Loomis Sales Core Bond Portfolio on 13, I would like to call attention to the duration of the portfolio is 4.5 years. That's the dollar-weighted maturity. And as we look at the credit quality on the right-hand side there, you'll see 29% in U.S. government or AAA versus 71% for the index. So this is a very proactive portfolio, and it was difficult for the last quarter, but we've seen that when the market goes back to a solid or a positive view of risk, how good the results can be here. Double Line is our other core fixed income manager. You'll see that their allocation to U.S. governments and AAAs is 54%, so it's much higher, and their return has been much more stable given that they've got a more diversified approach. In our view, yield drives long-term fixed income returns. Loomis Sales takes a very patient view of that, and they select individual corporate bonds to out-yield the market. Double Line is a little bit more tactical, a little bit more forecasting of individual sectors of the market and interest rates and putting that into their portfolio. Lord Abbett High Yield, again, this was not funded for the entire quarter. This is investing in high yield or below investment grade bonds, and you'll see their credit quality fits very nicely with the two previous ones, with a 38% allocation to triple Bs and no investment in governments and AAAs. So again, very little overlap in this portfolio versus the others. And then you'll see on page 16, Hoisington, everything in U.S. government and AAA, but everything at the long end of the duration or the long end of the yield curve, a duration of 20.5. So remember, this was the fund that was underperforming during the April report, but if you look back to the March report, they're up 5.16, beating the long-term government index by over 1%, ranking the 14th percentile. And over the last 12 months, had we invested with them the entire time, the return on this portfolio would have been 27.9%. This is not your typical bond portfolio. It does a lot of things for us, and that's why it's in place. The Vanguard 500 Index, this fund was in place for 1 day before this report was written, so we won't put a lot into that. But again, the results have been very stable in tracking the benchmark. Per your question about fees, so this, given the size of this allocation, the best fee that we could get is 17 basis points. But if the index fund provider came in and say, we're going to double our fee, that could cost you another 5 or 10 basis points. So we will keep a very close eye on this. Dreyfus Appreciation, remember this fund also performed very well during the month, but this is a very low volatility portfolio. That's why it's in here. It's to give us equity exposure, but it's to give us limited downside risk. If you look at the capture ratio, or how much does it go down, it goes down about 80% of the market when the market is down. It goes up about 85% of the market when it goes higher. Long-term results, we continue to believe that this plays a very good role for the portfolio. Vanguard Mid-Cap Index, again, this is another fund that was in place for 1 day. Its fee is 24 basis points, so smaller indexes cost more. This is still extremely attractive. You can see its results ranking very well versus peers and also very close to its benchmark. Hotchkiss & Wiley, we were pleased to be able to get into this. Remember last month we had to have a plan B in case we couldn't get into Hotchkiss & Wiley. This fund is soft closed to new investors. We've worked with Hotchkiss & Wiley for a very long period of time, and that was able to gain entry. This, again, fund was in for 1 day at the end of the quarter, and this is the other replacement of Delafield. And if you recall, the returns in April were quite good. Looking at the PE ratio here, 15.5 versus 19.3 for the value index. We feel very good about Hotchkiss & Wiley, given our experience with them. And then Stevens, another struggling portfolio, but again, one that did well during the month of April as market sort of came to its senses as far as risk, as far as being paid for risk. Stevens is a very, very cautious small cap growth equity manager. You will see that their allocation to healthcare is 20.3, but the index is at 23%. The composition of their healthcare allocation versus the index is dramatically different. They do not invest in biotech, so that is the top performing part of the market, and also we think one of the highest risk parts of the market. So they stuck to their guns there. They suffered relative performance during the quarter, but we don't think that the biotech run can go on forever. And then Causeway, our international equity manager, again, struggling a bit for the quarter, struggling a little bit for the year. Long-term results are very good. So as we go to the following pages, I think I'd like to ask you to turn to page 25, showing the pie chart with the diversification on the left. Very diversified, very different allocation scheme than it was 2 years ago. But then looking at the right-hand side, looking at in the risk-return space, so each of these bubbles represents a portfolio, their risk-return profile, risk being standard deviation on the horizontal scale, more risky to the right-hand side, and then return on the vertical scale. And each of those bubbles themselves, the size of it tells you how big they are relative to one another. So you'll see that we have a nice risk-return spectrum here. As it should be, most of our investments, as you go further right, are higher return over the past 5 years. Then we have a few, the Loomis Sales Core Bond, which is not looking great right now, and the Causeway International, which is also below where we would hope it to be because international has been so poor compared to domestic. But what this chart shows us is that for those portfolios that we are taking more risk, we are receiving more return where we would have over the past 5 years. So this is a good chart. And if you do take all of those bubbles and you put them together, it's in the composite, and you can see that the composite is positive, but we're always going to have a few that are below that line that you can draw through the middle of the composite up to Hotchkiss and Wiley. And the trick is to invest more in those that are, or to allocate to those that are below the line that are rising, and to take assets or take profits away from the ones that are above the line and about to revert to below, because we do believe in cyclicality. So that's all well, I think that actually I'd like to go to page 32, the expense comparison, just showing where the fees are of the funds, and then on a dollar-weighted basis or a weighted average basis versus the category average. So the expense ratio for the total trust, if you roll it up in its new allocation, would be 69 basis points per year. The category average of those investments would be 1.01, so 32 basis points savings, which doesn't sound like a ton, but it's actually 1/3 off almost of what you would be paying. And for a $36 million portfolio, that's pretty significant savings. Those are real dollars. So happy to take any questions.
Are there any questions? All right, thank you, Doug.
Thank
Appreciate
you.
it. Thanks for your work.
Thanks.
Next item that we have is discussion and approval of any asset allocation or changes to the portfolio fund managers, and I don't believe we have anything today. So the next item we have is acceptance of the interim financial report, and Amy Lucas is here from our Accounting Services Division. Laura Pappas is also with her. Laura is our controller, and so Amy's going to present the interim financials to us.
Good morning. Thank you, Mr. Chairman. I'm going to give you a brief summary of the financial statements, and then if you have any questions or whatever, then you can ask me. First, I'd like to direct your attention to page 3 under the management discussion and analysis. There's a chart there, the detail of ending plan net position. Currently, the trust is reporting the net position at $38 million. This is an increase of $4.5 million over the prior year, when net position was $33.5 million. Overall, the financial position has improved during the year. That's always good news. For the fiscal year, the trust gained approximately $4 million. Of this, $78,000 is from investment loss, offset by the $3.5 million from excess employer contributions and net assessed revenue of $648,000. Next, I would like to direct your attention to page 6. the statement of changes in plan net position. Additions are reporting for through March 31st at $22 million versus $26 million in the prior year. This is mostly due to the investment loss for depreciation at fair value of investments, as contributions remain stable. Benefits were $18 million, which was a decrease of $810,000 as a result of the indemnity and HMO plan expenses decreasing from the previous year. And according to the asset allocation guidelines in the notes, our fixed income securities were reporting at 26.3%, leaving the remaining equities to 73.7%. Our money markets used to pay claims are reporting at $3 million compared to the prior year of $5.6 million. Are there any questions regarding these financial statements that I might answer for you?
Are there any questions?
Mr. Chairman, it's not a question, but really more of a comment. I'm glad that we're keeping that cash balance lower for the cash flow this year than we did last year. I appreciate that, Bob.
That was painful. All right, thank you very much, Amy. Can I get a motion to accept the interim financial statements? All in favor? Any opposed? Next item is to ratify claims listing. All in favor? Any opposed? And the final item we have is any reports or comments from trustees or staff. Anything? All right. With no other information, then we are adjourned.